Get a look at the bigger picture. David Wright is with us, president, owner, Wright Financial Group. Thank you for being here. So we got in our consumer price index. We saw the revisions. I think there were worries what those revisions could be. It turned out it was encouraging for the most part when it comes to inflation. Now the Fed has some more data to take in and to make their decisions. What do you think the Fed may do, and what do you think the Fed should do?
Right now, I think the Fed should just hold fast. I think the market would like them to reduce, but when you see core PCE, which is the number one measurement that the Fed looks at, right, at 2.9% year over year, I mean, that's getting awfully close to the 2% that they wanted. We know that labor force participation rate has remained steady at 62%. Unemployment rate is at 3.7%. The bottom line with it, this jobs report that came out a week ago, absolutely crushed it. A lot bigger, more surprises in there in that number. But when I did a little bit of analysis on that number, I think what you're seeing is a lot of companies cutting hours of employees, which is causing multiple jobs for each individual, which might account for some of the extra jobs that were added. But boy, right now it's happy in the neighborhood. So I mean, you could make a very, very strong argument right now. The S&P up about 5.8 to 6%. NASDAQ's crushing it at 8%. Maybe we just stay the course right now and not worry about any rate hikes, right?
Part of the issue was that part of the discussion we saw from the Federal Open Market Committee and the minutes was that they don't want to cut too late and they don't want to cut too soon. And that's part of the risk. If they were to cut too soon, what could that, because everybody's, begging for a rate cut yesterday. What could be the downside to that?
I think the main downside to that, if they cut too soon, is that it sends the wrong message. I think it could also, there's a possibility, Nicole, of anything, but I think a reignition of inflation, that could be a concern. And I don't think that Jerome Powell, if he indeed is no longer going to be the Fed chairman, perhaps next year, we don't know. A Trump presidency would suggest he won't be Fed president, but I don't think he wants to go down in history as cutting rates too soon and reigniting inflation in the last few months of his reign. So the biggest risk to that is that, obviously reignition of inflation. But certainly when you look, Nicole, at the regional banks and how they're doing, especially New York Community Bank, that's the big thing that they have to watch. The Feds have to continue to watch that like a hawk. If consumers become concerned that they can't count on their regional bank to be something they can count on, the Feds need to make sure that regional bank stresses are held to a minimum. And we know that simply right now, they're all major league stressed out. So that's something that they have to watch.
Yeah, and for example, when we look at New York Community Bank, it just pulled it up. I saw it up 15% today. You have some of the insiders that are actually buying. Some of the insiders are buying. Obviously, that brings some relief to folks who have been watching it and have been very worried. But they've come out and they've talked about the deposits, and but have noted that what regulators, they're actually blaming regulators, thinking that the moves that they have done have been pretty foolish. And I guess a lot of rate hikes and that trajectory, really hits these regional banks. We thought maybe it was over. Some thought maybe it was over, but it's not. So just a week to date, still down 20%. Month to date, down 25%. 1 month down 54%. Would you buy into some of these regional banks?
I think some of the regional banks, it's a case by case scenario. I think New York Community Bank is certainly one of those banks that you wouldn't dump at this point. They did some cherry picking from Signature Bank a while back in Q1 last year. But I think that one of the main reasons they sunk for a while is that the Feds asked them to raise a larger contingent of equities to protect some of the loans that they have on the books, especially with New York City real estate the way it is, with vacancies and changes in job patterns and that sort of thing. But I think New York Community Bank is one that we'd hold on to. But, certainly across the board, regionals are, a little behind the eight ball from these large commercial banks that have this extra wing of investment banking that brings in a whole set of investment revenue that the smaller regional banks simply aren't on the same playing field, and they have to pay their depositors more, and that puts more pressure on those regional banks to continue to perform, which indeed will shrink their net interest margins even more. So the Fed's got to watch the regional bank situation very carefully. And of course, obviously, we brought this up before, Nicole, in our previous interviews, the consumer debt situation, where we're looking with 1.1 trillion in consumer debt in credit cards continuing to climb. I saw something before I came on the air today about Gen Z and millennial doomsday spending. I think a lot of people are spending money on their credit that they believe something bad might be happening in the future. So they're charging up things more, filling up their credit cards in that kind of that doomsday, oh, well, let's go out with a bang type of thing. So I think all of that plays into future rate cuts.
I see, I see. When we think about the other sectors like tech, the Magnificent Seven, do you like tech?
I do like tech in selective areas, but I would certainly say to you that the AI boom will, filter its way into companies that will start to implement AI, and where that could end up kind of biting the cheek meat of technology stocks are in those companies that implement AI and then eliminate middle management, HR positions, middle management positions that simply aren't needed anymore because of AI. So how will that in turn impact, our unemployment rate? Will that start to create the demand destruction that the Feds thought they needed to get to in unemployment up to 5%? Maybe it will. Maybe that'll all play out, but it certainly begs the question of what the future of AI is and how that'll impact various technology stocks.
Yeah, do you have an year-end target? I mean, when we're at 5,000 now, we've seen majority of the companies reporting and beating in a good way. I know there was lowered expectations, but still a lot of beats. Tell me what you think we may be at the end of the year from here.
I certainly think that to hedge my bet, I would say that we could be anywhere between 3,500 on the S&P to, who knows, 5,300, 5,400. I mean, it's just hard to say what's going to happen. You can't look at a presidential election year and say, well, the market's not going to do well this year, because that's certainly not been true in the past. 2/3 of the time in a presidential election year, the markets have done just fine. So as we look forward, it's going to be a matter of just kind of keeping our eye on what's happening with inflation, with consumer debt. And again, lastly, I want to reiterate the regional banks. We got to watch that all. But I know that's a waffling answer, but it's certainly, it could be one of those extremes.
Look, we got to watch for everything. David Wright, president, owner, Wright Financial Group. Thank you so much.